Investing can be a powerful tool for growing your wealth over time, but it can also seem complex and intimidating. However, with the right knowledge and a clear strategy, anyone can embark on their investing journey with confidence. In this guide, we'll break down the basics of investing for beginners, helping you understand where to start and what essential factors to consider. 1. Set clear financial goals. Before you begin investing, it's crucial to define your financial goals. Ask yourself what you're investing for, whether it's retirement, buying a home, funding education, or simply growing your wealth. Having clear objectives will help you determine your investment horizon and risk tolerance. 2. Understand risk and return. All investments come with varying degrees of risk and potential returns. Generally, the higher the potential return, the greater the risk. It's important to strike a balance that aligns with your risk tolerance and financial goals. Conservative investors might opt for lower risk assets like bonds, while those seeking higher returns may consider stocks or real estate. 3. Educate yourself. A strong foundation of knowledge is essential for successful investing. Take the time to educate yourself about different investment types, concepts, and terminologies. Books, online resources, and investment courses can provide valuable insights to help you make informed decisions. 4. Start with the basics. For beginners, it's advisable to start with simple investment options like stocks and bonds. Stocks represent ownership in companies, while bonds are debt securities issued by governments or corporations. Diversifying your portfolio with a mix of these assets can help manage risk. 5. Establish an emergency fund. Before you begin investing, make sure you have an emergency fund in place. This fund, equivalent to 3 to 6 months of living expenses, acts as a safety net in case of unexpected financial setbacks. It prevents you from having to sell investments prematurely. 6. Determine your risk tolerance. Your risk tolerance depends on your willingness and ability to weather market fluctuations. Assess how comfortable you are with the possibility of short-term losses for potential long-term gains. Age, financial responsibilities, and investment knowledge play a role in determining your risk tolerance. 7. Consider retirement accounts. Retirement accounts, such as a 401k or an individual retirement account, IRA, offer tax advantages that can significantly boost your savings. These accounts allow you to invest in a range of assets while deferring taxes until retirement. 8. Dollar cost averaging. A smart strategy for beginners is dollar cost averaging. Instead of investing a lump sum all at once, contribute a fixed amount regularly. This approach helps mitigate the impact of market volatility and allows you to buy more shares when prices are low and fewer shares when prices are high. 9. Keep an eye on fees. Fees can eat into your investment returns over time. Whether it's management fees, trading commissions, or expense ratios, be mindful of costs associated with your investments. Opt for low-cost options such as index funds and exchange-traded funds, ETFs. 10. Stay patient and disciplined. Investing is a long-term endeavor. It's essential to remain patient and disciplined, avoiding the temptation to react emotionally to market fluctuations. Stick to your investment plan and make adjustments based on your goals and risk tolerance rather than short-term market movements. 11. Diversification is key. Diversifying your portfolio involves spreading your investments across different asset classes, industries, and geographic regions. This strategy reduces the impact of poor performance in any single investment on your overall portfolio. 12. Avoid timing the market. Attempting to predict the market's highs and lows is a risky endeavor. Even seasoned professionals struggle with market timing. Instead, focus on your long-term goals and stay invested through market ups and downs. 13. Regularly review and rebalance. As your financial situation and goals evolve, it's important to review your investment portfolio periodically. Rebalance your portfolio by adjusting your asset allocation to ensure it aligns with your original plan. 14. Seek professional guidance. If you're unsure about where to begin or how to create an investment strategy, consider seeking advice from a certified financial advisor. A professional can help you assess your financial goals, risk tolerance, and design a personalized investment plan. In conclusion, investing for beginners requires careful consideration, education, and a patient mindset. By setting clear goals, understanding risk, diversifying your portfolio, and maintaining a long-term perspective, you can embark on a successful investing journey. Remember that every investor's journey is unique, and it's essential to stay committed to your goals while adapting your strategy as needed. With time, diligence, and informed decisions, you can navigate the world of investing with confidence and work toward achieving your financial aspirations.